folks, Dan Frio here, the Mortgage Update. Today is March 27th, 2020. So I tried to do a YouTube live and I had technical problems, so I apologize. But I want to go over what I wanted to talk about today is why we see mortgage-backed securities rallying, but you keep calling your mortgage lender or me and I'm saying, you know what, hold tight, mortgage rates are going up. There's a complete disconnect on what's going on. Look at where we're at today, and this is down from where we were earlier. We were way up here. Rates right now are about 3/8 to 0.5% higher than where we were down here. It doesn't make any sense. So let me make sense of this for you. I found a fantastic article that kind of explains a lot of this, and I'll put it in layman's terms. Okay, so what happens when we lend money to somebody? What happens once the loan closes? Well, a servicer comes in and says, you know what, we'll service the payments for you because we don't have the ability to collect payments. So we'll pay you 1% up front of the loan amount and we'll service this debt for you. Okay, cool. So their responsibility is to collect payments, pay the final person who holds the note, and I'll explain that in a second. That's where MBS has come into play. And then also accumulate the money, keep it on hand, pay the taxes, pay the homeowner's insurance, answer questions, everything that they need to do for the homeowner. So what happens is I do the loan, a servicer comes in and says, you know what, we'll pay you 1% of the loan amount to take over the servicing. Awesome. So then that loan ultimately gets sold to the final lender on this loan ultimately is Fannie Mae, Freddie Mac, Ginnie Mae, which you've heard of probably 2 or 3 of these, or they're bundled up in investment packages called mortgage-backed securities, sold as mutual funds and retirement plans and a whole bunch of other stuff. Okay, so think about it. You're the home buyer. You send in a payment to the servicer. They really don't even have your loan. They collect the payments, they pay your taxes, organize everything. Basically, they're the bookkeeper. And then they take a little spiff, they take a strip, and that's 30 basis points, okay, of your payment. Don't worry about the numbers. I'll make it make sense in a minute. And then they hold some money for your escrow, and they send the rest of the money out to either bondholders, Fannie Mae, Freddie Mac, or Ginnie Mae, okay? So they pay 1% to take over those services. So they're paying me to be my servicer. So they're saying, okay, so let's keep it at that. They're paying 1% to take over those services. They make 0.3% a year by servicing it. So if I get 30 basis points, 0.3, it takes me on average 3 years. So 0.3, 0.3, 0.3, I know it only equals 0.9, but that's for simplistic reasons. Let's say it takes 3 years to break even for what you paid me to take over the services of the mortgages that I gave you. It takes me 3 years as the servicer to recover my costs. And then from there, as long as people pay, you're making money. So if a loan is sitting on the books somewhere and they're servicing it and they're making 30 basis points a year, after 3 years, it's pure profit, okay? And that's why a lot of people service, because all they have to do is collect money, hold some of it, send the rest to Fannie Mae, Freddie Mac, Ginnie Mae, and the bondholders, and they're fine. Well, what's happening is, again, there's a 3-year period there to get the return on your money. People are refinancing very quickly right now because they refinanced last year, and now rates took a complete tumble, and they're refinancing again. So the servicers paid out 1%. They might have collected a half a year, say, so they made 0.1% on their investment, then the loan pays off. They don't collect any more payments. So they just lost 90% of the money that they put up as an investment. That's killing the market, okay? The next thing is the federal government's coming in and saying, you know, we need to help homeowners. And what we're going to do is allow them, we're seeking out Fannie, Freddie, all these companies to say, you know, give homeowners relief and let them go 2, 3, 4 months without making payments. I'm the servicer. I have to make those payments every month to Fannie Mae, Freddie Mac, Ginnie Mae, and the bondholders. Nobody's making their payments to me. So now what am I going to do? Oh boy, Now I have to go into my coffers and start making the mortgage payments for them while I'm trying to collect on this debt that people aren't paying me on. Now you have a completely double whammy. So that's what's going on. The servicers are saying, okay, we're taking a bath here. We need to make some changes. So the only way for me to explain this is I'll just read it. So this week, due to the accelerated payoffs or prepayments, and the uncertainty of prepayments, the value of servicing was slashed in half from 1% to 50 basis points. This dramatic decrease in value prompted margin calls for the many servicers who finance their acquisitions of servicing. So basically, they're financing the money to buy the loan so they can service. So they're financing or putting on a credit card, say, the 1% that they're paying us mortgage companies to take over the servicing. Additionally, the decreased value of the lender's servicing portfolio reduces the lender's overall net worth. Since the amount that a lender can lend is based on a multiple of their net worth, decrease in value of their servicing portfolio asset, along with the cash paid for the margin calls, reduces their capacity to lend. So that is now creating more of an issue. So now what's on top of all of this? So now what's the unintended consequences of this? So let's read through this and I'll kind of put my 2 cents in as we read to kind of put it in more English for you. The Fed's desire to bring mortgage rates down isn't just damaging servicing portfolios because of the prepayments. It's also wrecking chaos in lenders' ability to hedge their risks. Let's look at what happens when a borrower locks in their mortgage rate with a mortgage lender. Mortgage rates are based on the trading of the MBS market. That's why we follow the MBS market on a daily basis. As MBS mortgage-backed securities rise in price, interest rates improve and move lower. That's what I preach every day. A locked rate on a mortgage is nothing more than a lender promising to hold an interest rate for a period of time or until the transaction closes. The lender is at risk for any MBS price changes in the marketplace between the time they agree to grant the lock and the time the loan closes. Okay, so what happens? If the rates were to rise because the MBS prices declined, the lender would be obligated to buy down the borrower's mortgage rate to the level they promised. And since the lender doesn't want to be in a position of gambling, they hedge their locked loans by shorting mortgage-backed securities. Therefore, should MBSs drop in price, causing rates to rise, again, remember there's that inverse relationship, the lender's costs to buy down the borrower's rate is offset by the lender's gain on their short position in MBSs. So basically what a short position is, they do this commonly in stocks. When you buy a stock hoping that the price goes up, means you're longing the stock. You're buying it here and you're wanting it to go up and you sell it higher, okay? When you short a stock, basically you're buying it, you're borrowing it from somebody else who owns it, and you're hoping that the stock goes down. That is shorting it. So what will happen is you're saying, I'm going to borrow this stock from you at this price, and I'm holding it, and I'm hoping it goes down in value. Then I'm going to go in and buy it at that price, and then give you that share back at then replace your share. So I took it from you at 100. Let's say I sold it, and you had a share. It goes to 50. I buy the share back, one share at $50, and I give that share back to you, and I made the margin or the split in between the price I bought it from you or took it from you and what I sold it at. That's what shorting stock or shorting any position means. Now think about what happens when MBSs price or improve, causing mortgage rates to decline. On paper, the lender should be able to close the mortgage loan at a better price than promised to the borrower, giving the lender additional profits. However, the lender loses on their short position. Let me read this again. However, the lender's losses on their short position negate any additional profits from the improvement of the MBS pricing. This hedge system works well to deliver the borrower what was promised while removing market risk from the lender. But in an effort to reduce mortgage rates, the Fed has been purchasing an incredible amount of mortgage-backed securities, and that's what we've been talking about. Remember I said about 2 weeks ago, the Fed is stepping in and starting to buy up the market, creating additional demand, driving up prices, and driving down yields, causing their prices to rise dramatically and swiftly. So every day, remember we go through the markets and we've seen this dramatic changes that are very uncommon to the market. These losses appear to be offset on paper by the potential market gains on the loans that the lender hopes to close in the future. But the broker-dealer will not wait on the possibility of future loans closing and demands an immediate margin call. The recent amount of these lenders are paying in margin calls is staggering. They run into tens of millions of dollars. All this on top of the aforementioned stresses that the lenders are having to endure this. So while the Fed believes they are stimulating lenders, their activities are resulting in exact opposite. The markets of government loans, jumbo loans, and loans that don't fit ideal parameters have all but dried up. So we just came out, or this week we just stopped doing bank statement loans and a bunch of other loans until this all settles down, and it will settle down. Many lenders have no choice but to slow down their intake of transactions by throttling mortgage rates higher and by reducing the terms that they are willing to guarantee a rate lock. So this is why you're seeing mortgage rates go up. I hope you understood that. Where the lenders right now are getting squeezed out because people are refinancing so fast, there's not enough time to recover their monies. So that's kind of where we're at right now. Furthermore, the Fed's unintended consequences was announced to the cut interest rates on the federal funds rate by 1% to virtually zero. Because the Fed's communication failed to educate general public that the federal funds rate is very different than the mortgage rate. And again, my viewers, you know this because I talk, here's the federal funds rate, here's the mortgage-backed securities rates. There's no correlation. So you're much more educated than a lot of people, and this is probably over some people's head. But I wanted to at least get out this information out to you. It prompted borrowers in the process to break their locks and try to jump into lower rates. This dramatically increased hedge losses from loans that didn't end up closing. So we as a lender, when we say your loan is locked, we're actually hedging our money to make sure we have that money available at that rate for you. If you don't close, we lose money there. And a lot of people, they're like, well, we don't really care. Well, you should care, because if the cost and we're losing money, how do we recover our monies? All the lenders, not just us. You raise your rates. Okay, and that's the only way to do this. So this is going to be short-lived. Rates are going to stabilize. The refinance debacle is going to be here. If you missed the wave 2-3 weeks ago, or even last week, I'm asking my clients, put in an application. Let's put it in. Let's wait. It will come back, because with the economy, we're going to hit a recession, and I think we're going to hit a recession in the next few months if we're not already in it. But it'll be short-lived. It's not going to be like the 5, 6, 10-year debacles we had in 2000, 2008, and 2009. It's going to be very much short-lived. We'll get through it, but if you didn't lock in now, please put your applications in now. Okay, let's say the worst-case scenario, rates don't get any better, and you're good at where you were with what you have. Cool. Well, you lost 15, 20, maybe an hour tops of your time putting in your application and sending me all your paperwork. But on my side of the fence, I watch this every day, and you can see it. I got it on. I got 3 computers in my office. I got them all going at all times. So basically, I hope that clarified up to you a little bit on what's going on. But I'll try to share this or copy this article down below so you can read it and maybe break it down yourselves. But if you have any questions, let me know. But it's still, again, if you're out there and your mortgage lender, they don't have you locked, don't send me a lock, or don't send me an estimate that you had a week ago. It's no good. Get another one. Ask your loan officer, and I'm doing 50 of these a day. Ask your loan officer for an updated fee worksheet or a loan estimate, and then let's see where we are. But I'd love to help. So to reach out to me personally, and I promise you I'll get everything fixed, and we're going to start doing this Friday at noon live Central Standard Time. I want realtors on here, consumers on here, mortgage people on here. Let's work together trying to educate each other and help each other out. So God bless. If I can be of any help to you, reach out to me, 844-775-LOAN. That's 844-775-5626. Or shoot me an email at dfrio, which is FRIO, at preferredrate.com. And my website, thefrioteam.com, will be up. It should be up on the 5th is what I'm being told right now. And it'll blow your socks off. So God bless. Have a great weekend. And be safe and healthy. Bye-bye.